Hello and welcome back. Today we are talking about a major update that has caught the attention of millions of retirees and benefit recipients across the United States. Reports have been circulating about a potential $520 monthly raise connected to Social Security payments, with changes said to take effect in February. In this video, we are going to carefully break down what this type of increase would mean, how Social Security payment adjustments normally work, who could benefit the most, and what seniors need to understand about their retirement income moving forward. This explanation will be clear, simple, and practical so that every viewer can understand how these changes may affect their monthly budget and long-term financial stability. When people hear about a $520 monthly raise, the first reaction is usually excitement, followed by confusion. Social Security benefits are typically adjusted once per year through what is known as the Cost of Living Adjustment, often called COLA. This annual adjustment is designed to help retirees keep up with inflation and rising living costs. The adjustment is based on inflation data collected by federal agencies, and it reflects changes in consumer prices over time. In most years, the increase is a percentage rather than a fixed dollar amount. That means the exact amount each person receives depends on their current monthly benefit. A $520 increase per month would represent a very significant boost for many households. For some retirees receiving around $1,500 to $2,000 per month, that level of increase would represent a major shift in income stability. For others with lower benefits, the change would still be meaningful, but would vary depending on their current payment level and eligibility category. It is important to understand that Social Security benefits include several different programs, including retirement benefits, disability benefits, and supplemental security income. Each of these programs operates under slightly different rules, even though they are all administered by the Social Security Administration. If a substantial increase is announced or implemented, the first group most people think about is retired workers. Retirement benefits are calculated based on lifetime earnings and the age at which someone claims their benefits. Individuals who waited until full retirement age or beyond typically receive higher monthly payments than those who claimed early. Therefore, any across-the-board increase would affect higher earners and lower earners differently in absolute dollar terms. A person already receiving a larger monthly payment would see a larger dollar increase if the raise is applied as a percentage, while a flat increase would benefit lower-income retirees more proportionally. Another important group includes individuals receiving Social Security disability insurance. These beneficiaries often rely entirely on their monthly payments for housing, medical needs, and daily living expenses. Any increase in benefits can significantly improve quality of life, especially in times of high inflation when food, utilities, and healthcare costs continue to rise. For disability recipients, stability and predictability are especially important because many are unable to supplement their income through employment. Supplemental Security income recipients represent another category that must be considered. SSI is a needs-based program for individuals with limited income and limited resources. These recipients often receive lower monthly payments compared to retired workers, and even small increases can make a substantial difference. However, SSI payments are subject to strict income and asset limits. When benefit levels change, recipients must be careful to understand how other income sources, living arrangements, or support from family members may affect eligibility. Understanding how Social Security adjustments work requires looking at inflation trends and federal budget decisions. In years when inflation rises sharply, benefit increases tend to be larger. When inflation is lower, adjustments are smaller. The purpose of these adjustments is not to provide a bonus or stimulus in the traditional sense, but rather to preserve purchasing power. Rising costs for groceries, prescription medications, rent, and insurance premiums directly affect retirees who often live on fixed incomes. Therefore, periodic adjustments are designed to help prevent a decline in living standards. When news spreads about a significant monthly raise, it is important to separate official announcements from speculation or misunderstanding. Official benefit changes are typically announced through formal channels and are reflected in updated payment statements sent to beneficiaries. Recipients can confirm changes by reviewing official letters mailed to them or by checking their monthly payment deposits. It is always wise to rely on verified communication from the Social Security Administration rather than informal reports. If a $520 increase were implemented in February, beneficiaries would likely see the change reflected in their scheduled payment dates. Social Security payments are generally distributed according to birth dates for retirement and disability beneficiaries, while SSI payments follow a separate schedule. Payment timing does not usually change unless there is a holiday or weekend adjustment. Therefore, the structure of payment distribution would remain the same even if benefit amounts increase. For seniors planning their monthly budgets, an increase of this size could provide meaningful relief. Many retirees face rising housing costs, property taxes, homeowner insurance premiums, and medical expenses. Even routine expenses such as electricity and heating have increased in recent years. Additional monthly income could allow retirees to build small emergency savings, pay down credit card balances, or afford necessary home repairs. For those on tight budgets, the increase could reduce financial stress and improve overall well-being. Healthcare expenses remain one of the largest concerns for older Americans. Medicare premiums are typically deducted directly from Social Security payments for most retirees. When Medicare premiums rise, they can offset part of any annual Social Security increase. Therefore, when evaluating a reported raise, it is essential to consider net benefit amounts after deductions. A gross increase may appear large, but the actual take-home amount may vary depending on healthcare costs and other deductions. It is also important to understand taxation. Some Social Security recipients pay federal income tax on a portion of their benefits depending on their combined income level. An increase in monthly payments could potentially affect taxable income for some households. Retirees should review their annual income projections and consult trusted tax guidance to understand whether adjustments may influence their overall tax liability. Beyond the immediate financial impact, large adjustments to Social Security benefits also influence the broader economy. When seniors receive additional income, they often spend it within their local communities. This spending supports small businesses, healthcare providers, grocery stores, and service industries. Therefore, benefit increases not only assist individual households, but can also have ripple effects across local economies. It is equally important to address the long-term sustainability of Social Security. The program is funded primarily through payroll taxes collected from current workers and employers. Discussions about benefit increases are often connected to larger conversations about program funding and future solvency. Policymakers regularly evaluate how to maintain stability for current retirees while protecting benefits for future generations. While short-term adjustments help address inflation, long-term reforms focus on preserving the system's strength over decades. Seniors should also remain cautious about misinformation. Whenever headlines include the word breaking, it naturally creates urgency. Scammers sometimes use news about benefit increases to target retirees through phone calls, emails, or fraudulent messages. No legitimate agency will request personal information, bank details, or payments in exchange for processing a benefit increase. Any official adjustment to benefits happens automatically for eligible recipients. If a raise becomes effective in February, beneficiaries do not need to apply separately if they already qualify under existing rules. Increases tied to inflation or policy adjustments are typically automatic. Individuals who are newly eligible for retirement or disability benefits would still need to apply according to standard procedures, but existing recipients would not need to complete additional paperwork solely because of a general increase. Financial planning becomes easier when income is predictable. A consistent and reliable monthly benefit allows retirees to create structured budgets, plan for recurring expenses, and maintain stability. A substantial increase, if confirmed, would provide breathing room for many households that have struggled with rising costs in recent years. It may also allow some retirees to reduce reliance on credit cards or personal loans. While immediate relief is valuable, long-term financial health also depends on careful money management. Retirees who receive increased benefits may consider setting aside a portion for emergencies, particularly given unexpected medical or home repair costs. Building even a modest emergency fund can prevent future financial hardship. As this update continues to develop, clarity and verified communication remain essential. Beneficiaries should monitor their official payment statements and mailed notices for confirmation of any changes. Staying informed through reliable information helps seniors avoid confusion and financial risk. In summary, a reported $520 monthly raise effective in February would represent a significant change for millions of Americans relying on Social Security benefits. Understanding how such increases work, who may qualify, how deductions and taxes apply, and how to plan for the future is essential. Careful review of official information and responsible financial planning will ensure that any changes truly support long-term security and peace of